Hey everybody, Dave Brown with First Class Lending. This is Mortgage Terms Part 2. Our first term today is escrow. What does an escrow company do? Well, the escrow company is the disinterested third party that basically receives all the monies in from buyer, seller, lender for a loan if there's a loan involved, and then they disperse it back out according to their escrow instructions and the contract of whatever everybody agreed to. They make sure that title transfers correctly from seller to buyer, and that when all the dust settles, everything is done correctly. That's basically what the escrow company does. Title insurance company, what do? Well, they do a search on the title of the property to make sure there's no hidden liens, judgments, surprises on there that could come up later that could cause a problem for a new homeowner or for the lender. They then issue an insurance policy that protects the new owner and protects the lender, so if something goofy does pop up that we did not know about, the insurance that they put on that property would take care of that lien, and the lender and the new homeowner would not be responsible for it. Earnest money deposit, or EMD. Typically in California, when a buyer makes an offer on a home, they agree to put a deposit into escrow that tells the seller, hey, I'm serious and I'm willing to put that deposit at risk even after certain contingencies pass, because I really want to buy your home and I know that I can perform and I will perform. Okay? Usually about 2% of the sales price is typical, but that's all negotiable between buyer and seller. Escrow impound account. An escrow impound account is typically for taxes and insurance and mortgage insurance if it's applicable. Those all become part of somebody's mortgage payment. So 1/12 of taxes, 1/12 of homeowner's insurance, and then the monthly mortgage insurance, if applicable, are all lumped together as part of somebody's mortgage payment. The lender then takes the insurance, the mortgage insurance, the tax portion, puts it in a separate bucket, and as those items come due, twice a year for taxes, once a year for insurance, they pull out of that bucket and pay it for the homeowner. The homeowner doesn't have to pay for it themselves. A lot of homeowners like that because it's convenient, allows them to budget on a monthly basis, but it is not required unless you are putting less than 10% down on a loan in California, or a home purchase, excuse me. And the last term that we want to talk about today are points. You've probably heard that term before. What are points? Points is an additional loan fee that you could pay up front to get a lower interest rate. For example, today perhaps you could get a 3% interest rate with no points, or you could pay 1 point and get 2.75 as an example. 1 point is 1% of the loan amount. So if you're doing a $400,000 loan, that would be $4,000. You would pay more up front to have a lower monthly payment, and then you do the math for the break-even point. If you're saving $50 into 400 would be what, 80 months? And you would just look at that and say, you know, am I going to be here longer than 80 months? Maybe it's worth it, maybe it's not. I'm saying most cases we don't see points charged on our loans. Most of our loans tend to be at 0 points. Hope all that made sense, and if you have any questions on anything, give us a call. Thanks.